Jim Rickards, a renowned economist and investment advisor, has made a bold prediction that the United States is headed for a major recession that will impact most people in the country. In this video, we will take a look at Jim Rickards predicting a horrible recession that will affect most people in America. He also elaborates on monetary system's history and what it can teach us in terms of a possible collapse of our current one going forward. To begin, the next stock market crash, Jim believes, will be different from previous ones because the government and the Federal Reserve will not save the day this time. This is because in order to avert a financial or economic crisis, the Fed has boosted the money supply and decreased interest rates during the last few decades. Rickards is not new to making such predictions, as he has been warning of an economic crisis for several years. He believes that the current monetary system, which is based on debt, is unsustainable and is headed for a major collapse. He predicts the stock market will remain in decline for years, if not decades, as it did following the coronavirus crash or the 2008 financial crisis. This is because the safeguards we just discussed will not be effective this time. Why is Jim Rickards saying that they won't work this time? He believes that over the last few decades, regardless of how much money the Fed manufactured and pushed into the US financial system until last year, there hasn't been massive inflation of the magnitude observed today. He states that prior to last year, inflation was averaging around 2% and has been declining since the 1990s. Inflation has grown this time, though, since all of our money poured into the economy to boost consumer spending is not reaching the consumer. It is being directed into the bond market, the stock market, and the banking system of the United States. As a result, rather than pouring into the economy and producing inflation, newly created money has been going into assets, causing huge bubbles in almost every sector of the economy. This is because many people have understood that with the free money being thrown into the economy by the Fed, they may become wealthy. He points out that investors recently invested more money into equities in a single 5-month period than they did in the previous 12 years combined. With interest rates currently at one of their lowest levels in history, Jim claims that the Fed will not be able to manage inflation by raising them since every time it has tried, a catastrophic market crash has occurred. He says that the Fed is in a tough situation because it must choose between raising interest rates to prevent inflation and keeping the bubble in place. People will suffer regardless of the option, he claims. He thinks that those attempts will be futile because the current instability is caused by supply shocks. It is much more than just oil. We are witnessing massive supply shocks practically everywhere we go as a result of the Ukrainian conflict and the aftermath of the coronavirus lockdowns. Everything from food to gas to electricity is in short supply. Videos from throughout the country show empty shelves. He claims that the last time something like this happened was in the 1970s, when the stock market was ineffectual as a hedge. After 1965, the Dow Jones fell by 74% and did not recover for nearly 30 years. As a result, the value of people's retirement accounts decreased as prices soared. Jim feels that the stock market is currently in a massive bubble by any measure. To clarify this, he gives us a chart of the market cap to GDP ratio. He believes that the market capitalization to GDP ratio is a good indicator of how much money has been invested in the stock market in relation to the size of the economy. He believes that it is multi-billionaire Warren Buffett's favorite indicator for predicting market catastrophes. According to Jim Rickards, the chart was at its peak during the dot-com bubble, and Buffett predicted a downturn. He was proven correct. The market did not recover for 15 years. The indicator is presently 113% higher than it was during the dot-com bubble's height, which Jim interprets as more free money streaming into the US stock market than at any other moment in history. If this is taken away, the market will fall even worse than it did during the tech bubble. Another graphic he shows is the margin debt chart. The margin debt chart shows how much money investors borrow to invest in the stock market. Margin debt peaked over $500 billion shortly before the 2000 crash. According to the graph, when investors borrow to invest in equities, the majority of people's debt-to-net worth ratio is rising. Debt surged once more in the run-up to the 2008 financial crisis, as people leveraged their accounts. Margin debt levels are at an all-time high today, according to Jim, with nearly $1 trillion of borrowed money floating around in the stock market, more than doubling what they were before the 2008 financial crisis, when the market fell by nearly 55%, and this excessive debt is cause for concern. They are also higher than they were before the trade war. As a result, he predicts the subsequent crash will be one of the quickest and most violent in history. The Shiller PE ratio is the last graphic he shows. According to Jim, the Shiller PE ratio is a bubble indicator established by Nobel Prize-winning economist Robert Shiller. It determines how expensive stocks are in relation to their earnings. According to what he's reading, it's at its highest point since the Great Depression. Another reason Jim Rickards feels the government and the Fed are powerless to help is that raising interest rates will cause more harm than good. He cites Japan as an example, which experienced this in the 1990s. In the 1980s, Japan experienced a similar situation, with a large asset bubble created by low interest rates and easy money. Everything appeared to be in order since their real estate and stock markets were at all-time highs, just as they are in the United States today. The stock bubble burst in 1989, when the central bank elected to gradually deflate the speculative bubble, and the Nikkei dropped by more than 60% in just a few days, resulting in what is sometimes referred to as the lost decade. As a result, Jim warns that if this happens, the market will crash in the same way that the Japanese market did back then. Jim Rickards believes a market crash is on the way, and that the time to prepare is now. He adds that if he had to pick a date when he expects everything will fall apart, it would be in the middle of June, because the entire world is currently in limbo as everyone waits to see how the Fed will act. He chose that date because it is when the Fed will meet to decide whether or not to raise interest rates further. He believes that if they raise them by more than 0.25%, which is increasingly likely, the markets will crash the next day. He recommends keeping enough cash on hand to cover at least 3 to 6 months of spending. Despite the fact that inflation is depreciating money, he predicts that the majority of people will be wiped out in the early stages of the crisis as the market crashes and they lose their jobs, homes, and retirement funds. As a result, he says that having a small amount of cash on hand will keep you well protected against the impending storm. Part of this reasoning is that the market needed time to recover in 2008. Investors who stayed in the market had to wait a long time for it to recover, according to Jim Rickards, whereas those who shifted to cash and bought even a normal index fund near the bottom of the market could have tripled their money in the same time frame. To help with this, he recommends turning a large percentage of your portfolio to cash because having liquidity reduces your downside during a crash and allows you plenty of ammunition to re-enter the market at rock-bottom prices after the slaughter is over. This is in accord with the cliche that the ideal moment to buy stocks is when there is blood in the streets. This was suggested by Nick Giambruno. The Fed funds rate of change is incredible. Never before has it risen by such a high amount in such a short period of time. This will jolt the system. Bonds and housing, for example, are going to suffer. The repercussions of these rapidly increasing rates will be catastrophic. And with that being said, it is time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.